All right, hi everybody, this is Jeff Fowler with the Apartment Owners Association. It's great to have you with us today. As always, we're going to be covering DSTs, and this afternoon we're going to be covering some changes to the ADU rules and show you how to maximize the income earning potential for your property, so that'll be great this afternoon. Anyway, thank you so much for being a member with AOA. I know many of you are, and if you're watching maybe new for the first time and you're watching from AOAUSA.com, this is being recorded and you can catch it after the fact, and we have many recordings on YouTube. And just like AOAUSA.com, AOA USA is the name of the channel. So if you go there, you'll find a video for how to maximize your membership and all kinds of stuff. So check that out later on. Welcome everybody. And I am excited for the trade show that's going to be coming up August 20th, Long Beach Convention Center. It is free if you bring a toy. We are partnering up with Union Rescue Mission, and they're going to get those toys to kids that are in need. So if you think of them, that would be great. Think of your friends, though, that they can come for free. Invite a friend, come on out. There's going to be over 150 vendors, and we have about 20 different seminars all throughout the day. So it is just time to sharpen the axe, folks, and so definitely do that. I don't know if you caught it yesterday. We sent out an email from the AOA Political Action Committee for LA County. They it looks like either a vote's coming up pretty soon where they're going to try to make a requirement to have 82 degrees be the maximum temperature that they would allow in LA unincorporated. So if you are in that area and you did not get a message, go to our PAC website, AOAUSA.com, and then /PAC, Political Action Committee, PAC, and you'll see the campaign there. You can click on it, you enter your information, you can even edit the email and send that out. And anyway, we just want to advocate for you, for all of us, for the industry. And you know, when I call them and I can say, hey, not only do we have 20,000 members, but we have this 1,000, so, you know, however many people click that thing and sent them an email, it adds weight to what I say when I go to meet with them. So please click on that and respond. And you do need to be in LA County because it asks for your address. So if you're out of the county, you don't need to participate on that one. There's a lot of stuff going on, so definitely if you're in the area, going to the trade show will be great just to understand, just to get the download. Anyway, we had a live stream the other day, insurance cancellations, non-renewals, and those inspections. We had 10 tax strategies for real estate investors, 10 ways to keep residents happy by a property management company, security deposit crash course. We've had a lot of different really good content that you can check out on the website, so please do. And you know, our speaker today, he also is going to be speaking at the trade show. He has a 10 o'clock slot in one of the Power Talks, and his booth is right across from the AOA booth at the very center of everything. And so you'll want to meet up with him and hear what he has to say at the show. But yeah, he is, okay, well, yeah, first of all, H&S, I want to give a shout out to them. They're sponsoring this live stream specifically. They focus on 1031 exchanges, investments for their clients, and they do traditional wealth management as well. And they've been advertising with AOA for over 20 years and just done a great job. Our speaker today is a real estate and securities professional. He's a partner to Bob Horney at H&S Wealth and local here in the Southern California area. So Adam, Bryan, it's great to have you with us.
Thanks so much, Jeff. Appreciate it. We've, yeah, I think back, we were probably the first DST 1031 company that was working with AOA, and now there's a lot of folks that are out there as this industry industry has grown, and that's partly what I want to talk about again today. Again, it's Adam Bryan is my name. I've started in this business in 2002, actually, so I've been doing it almost exclusively for a very long time. I've literally lost track of how many investors and how much money has been raised for these DST investments that I've been involved with, either directly or indirectly, but we're talking in the neighborhood of somewhere between $500 million and $1 billion in real estate, and somewhere around 500 investors that are clients past and present. So I've been around the block, so to speak. I've seen the good, the bad, and the ugly of the 1031 industry, the DST industry, what used to be called the TIC industry, through the Great Recession and through COVID and through the positive times in the mid-2000s. And so that's why I feel like I'm qualified to talk to you today about it. The industry has grown. It's become somewhat well known, but relatively speaking, it's not. DSTs are securities. They're real estate ultimately, but they're sold as securities, and that means you have to be securities licensed to offer them. There are a number of rules that SEC and FINRA put around the marketing of this product, and one of them is that it can't be generally solicited, which is to say advertised. That's why a lot of people haven't heard of this. You have to kind of know someone who works in the industry, and I have to know who you are before I share it with you. Make sure that I know that it's suitable for you. It's a protection for investors, but it also makes it kind of a well-known secret. And a lot of things are not known or understood. Usually about 1 in 10 people that I talk to brand new has even heard of a DST. But I'm going to talk about it a bit today and how it applies for 1031. But as you saw in the title of my talk today about the catch, you know, I'm by nature a doubting Thomas, a very skeptical person, and very cautious, particularly because I'm dealing with my clients' money and because most of my clients are older. This product makes the most sense usually for folks in their 70s and beyond, and hence it's a very sensitive time. You don't want to be making big mistakes that late in your financial life. So as a result, there's some things that I talk to with my clients that I don't think are necessarily as commonly shared by other folks that do these types of offerings. And as some of you know, there are many talks and seminars and folks in my industry that do what I do as well. But I thought I could give you a little bit of an inside track. So gentlemen, if we could pull up the first slide, I'm going to go through a couple of slides with you. As I mentioned, it's sold as a security. There are strictures and requirements around who the investors are. You have to be high net worth or accredited to even invest in one. That just means $1 million net worth, excluding your home equity. There's risk, all the usual disclosures that you can see there. And as you'll see, it's a little hard to read, that if you have any questions, you can type them in the boxes I'm going, and we'll address them at the end. Okay, we'll go to the next slide. So when we talk about DSTs and 1031s, before that even happens, you have to sell a property. You have to be doing a 1031 and selling one of your investment properties. It begs the question, is it a good time to sell? And what I often talk about is it depends on the individual, not necessarily where the market is. Right now, the market's a little dysfunctional. I would argue it has been for the last few years. There's fewer transactions. In some market areas, it's down 50%, fewer buying and selling activity. And it really just depends on you. If it's the right time for you to sell, maybe it's not the top of the market, but maybe that's okay. And part of my job is to help you figure that out, not convince you to sell and go into one of these DSTs. I wouldn't consider that good advice at all. So the answer is it depends if it's a good time. Right now, prices are up slightly. I know there's been some reductions in some markets, but generally prices have been holding. However, a lot of buyers, both investors and regular home buyers, have been locked out because of the quote-unquote higher interest rates. Potentially, the Federal Reserve will bring down the overnight rate, which means that interest might go closer to 6.5% on a typical loan. Right now, it's closer to 7%. But that's really not that high historically, as many of you know. However, in the last 10 years, it seems very high, since we were sort of addicted to 3% interest rates for a long time. So if it's time for you to sell and you have a good broker marketing your property, maybe it is a good time. But then what do? You either pay the tax, which would mean that the profit's going to be calculated, the capital gain, and you're looking at about 35 to 40% of that money going to the feds and to the state. So all that hard work and all that equity you've built up, a lot of it's going to be bitten into if you sell your property and cash out, as I call it. The other option is you can buy another property and do a 1031 exchange. Nothing wrong with doing that if you still want to be in the landlord business. However, you are trading one headache probably for another, and if it is the top of the market and you're getting paid a good hefty price for your property, you're also going to pay a hefty price for the replacement. Most people think that's the end of the story. Those are your two options. There is a third option. It came about back in 2004, and it's called the Delaware Statutory Trust, or DST. Essentially what it is let's go to the next slide. It's first of all just a legal structure, kind of similar. Oh, here's some examples. I'm sorry. Just to give you an idea, they generally are $50 to $100 million properties. They can be any type of investment real estate, everything from office buildings to distribution centers to apartment buildings. And let's see the next one. It's simply a structure like an LLC, like a partnership, but it's neither of those things. It has some of the features and benefits of them, but it's a unique thing that really didn't exist before 2004 when the IRS issued a revenue ruling that said if you invest in a DST for your 1031 exchange, it is the same as investing in another real estate asset, another traditional real estate asset. It qualifies as a fractional co-ownership interest in real property. Technically, you own an interest in a DST, and that DST's only purpose, only reason for existence is to own that property. It's not a pool of properties, it's not a REIT, an REIT, it's simply a way to hold title. But it records as a single owner, which is the DST itself. And again, each one is newly created with each property that's acquired. The way it starts is a sponsor company or a real estate company will scour the nation and try to find one of these advantageous properties. They will buy it with their own money. If there's leverage, a loan, they will take out the loan in the name of the DST. That sponsor company is the trustee of this newly created trust, so they would sign any guarantees required, come up with a down payment out of pocket, and buy the property. At this point, this DST now is going to be sold off to individual investors through financial advisors like myself. That the sponsor is essentially pulling its capital out of the investment and going on to their next deal. Meanwhile, they stay in place as the asset manager, taking care of the property, sending distributions to investors, etc. They're the responsible party since someone has to kind of be in charge. We can go to the next slide. I'll talk about the real estate in a moment. We're seeing a lot of all cash offerings now, as well as leveraged offerings. You know, interest rates being where they are, you're able to eke out a decent cash flow sometimes without using leverage. The leverage amounts are really conservative these days. One could argue that 30 to 50% loan to value is almost ludicrous. Most people would come up with what, 20% for a house, 30% for an apartment building. Well, now we're having to come up with 50 to 70% down. You know, it gives you some security when there's no loan, but there's also some benefits. You can trade up and buy more real estate, which is depreciable. You're able, of course, to deduct the interest payment on the loan, so there's benefits to both models. But when there is leverage, unlike in the mid-2000s when we were seeing upwards of 80% for investment property, which is very unusual, now we're seeing 30 to 50% loan to value. Those beneficial membership interests, that's the formal title for what you're actually owning, are the equivalent of owning a deed to real estate or a fractional deed. You own 0.5% of one of those $50 million properties, but it functions the exact same as if you owned that as a single property, as a single asset. And we'll go to the next slide, please. Everything flows through pro rata, meaning if you put up 1% of the money for the investment, 1% of the distributable cash flow will go to you, and it is monthly distribution, by the way. All the expenses and depreciation you can claim, you get your share, which would be the equivalent in this example of 1%. The debt service, the loan payment, you know, you take that off as an expense, 1% of it is going to be deducted. The IRS very much wanted this to be like pure co-ownership. meaning you're not diluted. In some old investments, and even current ones, a sponsor company might take a portion of the profit when it sells. Maybe 20% is a very common amount. Then it's not allowed for a DST. 100% has to flow through to each investor based on their contribution. That was very much by design. You can have up to 499 investors in a single DST. I mention this not because you're in partnership, but you're not. You don't even know who these individuals are, and it really doesn't matter who they are. You all each own your share. In real life, it's more like 1 to 200 owners because they raise all the capital they need with that many people. It's all coordinated through the sponsor, so they keep track of who everybody is. And the good news about it is that it brings the minimum investment down. So for any one DST, maybe you can put in, instead of $500,000, $250,000, and then do another DST for another $250,000 to cover your $500,000 on your exchange. Remember, the IRS wants you to buy equal or greater value of what you sold. But now you can buy 2 or even 3 or 4 properties that are all in maybe different states, maybe different types of real estate, maybe different sponsor companies. You're getting this huge diversity that you really couldn't get otherwise, especially if you only have around $500,000 in equity, which is pretty typical. So it gives you that opportunity. And the biggest thing, I often say the best thing about a DST is also the worst thing, and it's the same thing. It's the control issue. You know, you make decisions on your property, you've built up your wealth, you know what you're doing, I'm sure, especially if you own Southern California real estate. Well, when you're in a DST, you're letting go of that. And one could argue that's not a happy feeling. Some people want to control their investment, make the decisions, determine lease rates, hire the vendors, etc. Many people that I talk to, especially, as I mentioned earlier, in their 70s and 80s, they want to be done with it. They frankly don't even want to own real estate anymore, but they have to, otherwise that 30 to 40% tax is going to kick in on the profit. Well, many of them are relieved to hear that they're not dealing with the famous 3 Ts, the toilets, tenants, and termites anymore. That's all handled through the sponsor. They're the responsible party. They either physically property manage the property or hire a local expert to manage it, and they oversee it. And that's a relief to a lot of people. Frankly, it's why I have a job. A lot of older investors, this is a wonderful solution for them. And the next slide. How long are you in these things? You know, it varies. It's ultimately real estate, as I said at the top, but typically we're looking at a 6 to 8 year hold period that it's going to be operating. The sponsor's hopefully increasing the rents. The value is hopefully appreciating. And within, call it 6 to 8 years, the sponsor's going to decide to sell. They will notify all the investors and probably give you some options for replacements, but you don't have to stay with that same sponsor company. You can go to a different one. You can go back to buying your own real estate. You have all the same 1031 options as you had when you went into this investment. Common question, probably somebody will put it in the chat, but I'll steal your thunder right now. Can I get out early? What if how locked into this thing am I? Technically, I have to tell you that a DST is an illiquid investment, but also every property you own, regular real estate that you own, is also an illiquid investment, meaning the government says if you essentially can't push a button in a market on a daily basis, you don't necessarily have direct access to your funds. It's tied up in the property until it sells. So that being said, you can sell your interest in a DST early or before the whole property sells. You have the right to do it, you have the ability to do it, and you make all those decisions, whether or not to do it, what to charge for that property, etc. The problem is there is no secondary market for these interests. Every DST has a provision that says that the other co-owners in the same property will have an opportunity to buy out someone who wishes to exit early, and we have seen that happen on occasion. If you can come to terms with that buyer, the truth is it's a very easy, quick transaction. There's no title or escrow or loan assumption. It's just one DST interest growing and the other one shrinking or disappearing. But you can't rely on it that it's guaranteed you'll be able to sell. We just don't know. The reality is in the Great Recession, a lot of people wanted to get out. There were very few buyers. In the recent times where we've seen a nice appreciation, especially in the last 5, 6 years, some people have exited early and fellow co-owners in the same asset bought them out. Occasionally it'll go out to the open market, but frankly very rarely. I don't see that happening very often. which I think means two things. Either another investor is buying them out or they're just not selling. But know that you have the potential option, death or emergency or college tuition. It is possible to do. I just don't advise you rely on it. Okay, next slide. Okay, so the bulk of my talk today is going to be about things to remember and keep in mind. And you can take it down now, Israel. There we go. So first of all, who are these sponsor companies? That's an important decision. And how many are there and what are their backgrounds? When you look at a DST, I want to share with you some things that you may or may not hear. Let me give you the numbers. In the mid to 2004 to 2008, right before the recession, there were 72 sponsors that were active in the peak. They were all members of the same trade association, is why I know that number directly. And they all had one or two or more per year offerings going out. With the recession, a lot of those sponsors went by the wayside, got down to the low teens from 72. Now, the properties that those sponsors were selling, offering, they didn't necessarily disappear. The properties are still there. It's just that the companies that put the investment together and managed the investment weren't able to continue. And that spoke to their lack of financial depth and background and experience. They just weren't able to make a go of it. That being said, if the real estate held up, if it was good quality real estate, it would continue on. What would happen is a new DST trustee would have to be found, and a new company would take over the management, essentially, of all the investors and the property. But you don't want that to happen. That's not a pleasant experience. It happened to a lot of people, and that's because there were many new companies, especially 2003, 4, 5, that jumped into the market. So it's something to be aware of. How long has this company been around? Were they around prior to the Great Recession? You know, going back now to, I guess we're going on almost 20 years. Something to think about. The principals versus the company's experience. So when I talk about how long they've been around, I mean under that operating model, offering these DST investments, managing them, and having years of experience doing that. What I'm referring to is a lot of newer companies, because they only have 3, 4, 5 years of experience, which doesn't sound very impressive. What you'll see them emphasizing is the experience of their principals, meaning our management team has 80 years of experience in commercial real estate. Now, there's nothing wrong with saying that, and it is factual, but it isn't the same as saying this company has been offering this type of investment for 15 years or more. That's what I stress that you think about and you look at and you dig into, because even though the CEO has 20 years of experience and the financial controller has 15 years of experience, that doesn't mean there's 35 years that this company's been doing this function. In fact, that company may be a brand new company, but they're going to talk about that 35 years of experience in my example. That's the kind of thing I recommend you look out for. Some sponsor companies have their own broker-dealers. I mentioned that individual advisors like me are the ones that raise the capital for the sponsor companies, and that's the typical model. Most sponsor companies aren't in the business of raising money. They're in the real estate business. They get the financing, or they have their own cash. They buy the property, arrange financing as appropriate, and then they go out to the independent broker-dealer network, again, advisors like me and my partner Bob at H&S, to raise the capital to get their money out of the investment. And that's a pretty common model. There are some sponsor companies that raise money internally, and some who raise money for other companies and their company. They do both. Now, as long as this is disclosed, there's nothing wrong with it. There's nothing dishonest about it. But to me, there is an inherent conflict of interest if the company that's supposed to be bringing you the best DST investment and choosing from what's out there also works for one of those companies. The way I liken it is, if a realtor, you're trying to buy a house, and a realtor that's working for you sells you his or her own house. Doesn't quite sound right. As long as it's disclosed, again, there's nothing improper or illegal, but there is always going to be a conflict if the rep or the advisor who's supposed to be looking out for your best interest is also selling you an offering that's only available through their company. I do see that in the market with a couple of firms. Financial strength, how much money, what the backing is of the company. of the sponsor company, it's only somewhat relevant. First of all, most of these companies are private. They're not traded on the exchange. They're not recording and reporting to the public on their financials. So you have to dig in a little bit about who these companies are, what their backgrounds are, whether or not their financials are made available. One company that I work with will actually have an independent auditor come in and give you a copy of that report, but most do not do that. Now, why does it matter? Well, if, let's say, we go through a recession like we did before and a lot of challenges happen, and these companies can no longer continue to bring in new DST offerings, and they're not making very much money during the operational period as the asset manager, that's not really where their profit margin comes from, they may go out of business. Well, you want to not have to deal with that. Like I said, the property will hold up if it's doing well, you just have to replace them. But that's very difficult. You've got maybe 200 people who don't know each other making this decision. It's a mess. And so what you want is a company that has the background and the financial strength that's been there, again, for at least 10 years, if not longer. I prefer companies that date back to the 40s, even 1940s, before this whole industry existed. So you want to ask that question as far as the financial strength. What happens if this sponsor is no longer bringing out new offerings? They only make a little bit of money during the hold. That's not their business model. It's not their profit center, so they're going to go out of business. That's what happened when I mentioned earlier that there were 72 sponsors at the peak of the real estate DST and TIC market, and it went down to the low teens. All those companies went away. Not the properties. The good ones held up, the bad ones didn't. Overall, the industry performed better than the average real estate asset, in fact. But a lot of those sponsors went by the wayside, and we don't want that to happen. And lastly, do they have a full cycle track record? Extremely important. They've gone through, they've raised the capital, and then they've sold the offering and held it after 6 or 8 years. What was that return? What was that profit? That's something you want to see. Obviously, if they're a newer company, they won't have a track record. And at least with H&S, we almost never deal with those companies, not because they're bad guys, not because we don't think that they're buying good real estate. They just don't have the experience, the track record. So one thing you want to ask for is that full cycle track record. What type of real estate? Well, a DST can be any kind of investment real estate. We prefer Class A multifamily, higher end or luxury apartments, and self-storage facilities. Why? Because those are the two asset classes that held up the best. We do see a lot of triple net or NNN, net properties out there. That basically is a type of lease, and any kind of real estate can be triple net leased, which means that the tenant is responsible for the taxes, the insurance, and the upkeep of the property, the net of all of that. Nothing necessarily wrong with that model, except those lease terms tend to be very short, meaning CVS signed a 20-year lease 10 years ago, and now it's being presented to you as a DST. There are now 10 years remaining on that lease when you invest in it. If the property is held for that 6 or 8 years, like I mentioned, now there's going to be 2 to 4 years remaining on that lease. Well, that's a much less attractive offering, certainly than when it was 20 years or even when it was 10. So that's something to be aware of. No matter how strong the tenant is, if the lease is running short, it's just going to decrease the value. You get a little better return for those offerings, but frankly not enough, I believe, to compensate. And then what happens if your tenant is Neiman Marcus or Sears or JCPenney or Payless Shoes or Radio Shack or Nordstrom, and I could go on. Obviously, a lot of retail, in particular companies, go out of business, and some of them can honor the lease even if they close the store. Many of them can't. But even if they're honoring the lease and paying you every month, if they move out, you now own an empty building, which is very expensive to retrofit for a new tenant coming in when that lease expires. So no matter how good the credit worthiness, whether it's Amazon or I used to say the U.S. government, but I'm not so sure about its credit anymore. It doesn't really matter if the lease term is short or if they decide to close the facility, even if they're honoring the lease. Lastly, B and C apartments. A lot of us own, lower end, older apartments, call it more than 10 years. A lot of money can be made. A lot of you have done very well with those types of real estate assets, but they do suffer the most in a recession, number one. Obviously, everybody's impacted, but frankly, folks at the lower end of the income scale get hit hardest and first in a downturn. Whereas the higher end folks, they get impacted too, but not as severely, which means that they're able to pay their rent more typically. One thing we learned with the pandemic, using the same philosophy, I've always stressed higher end luxury apartments. But guess what? The people that have those jobs, it turns out they can work remotely for the most part. If you're cutting hair or waiting tables or doing real work, you couldn't go into the office for 6 months to a year. Now the government, of course, tried to help out, but it created a lot of problems with non-payment for landlords. And in fact, the government said you also could not evict them during the pandemic. We didn't see as much of a problem in the higher end luxury market. Folks were actually saving money because they weren't going out as much. And all their work they were able to do remotely, many of them, young professionals and tech people and lawyers and so forth. So again, the luxury apartments hold up the best. Self-storage, there's 1 in 10 households in America has a self-storage unit. Small businesses, about 15% of the units are taken up by small businesses who don't need a whole warehouse. They just need some space. Very easy to manage, month-to-month rents, just like apartments after the initial term, which means you can keep up with inflation. And that, of course, has been a big issue lately. Senior housing, student housing, we can chat about those different types of properties moving forward if you're looking at doing a DST, but they all have risks and challenges that we don't see with Class A multifamily and self-storage. So with that, I'm going to hand it back to Jeff. I think we might have some questions, and take it away, Jeff.
All right, thank you, Adam. And again, Adam will be speaking at 10 a.m. at the trade show, so please catch him in his Power Talk. We have Wanda with a question here. She's interested in 1031 exchange, either into Sacramento, Idaho, or Utah. And so she's wondering what their tax and zoning laws are. And, off the bat, you're not a enrolled agent. You're not a tax professional necessarily, but please go ahead and respond, though, anyway.
I think I can address that. So, first of all, 1031 was designed by the federal government. It actually goes back to 1922, so it's been around a very long time, and it's really only had a few changes over the years. You can do any investment property in the United States domestically and sell and buy another property domestically in the United States, and as long as it meets the standards as far as buying equal and greater value and nominating in a timely manner and all the usual 1031 rules, you can buy anything. If you owned a foreign property, like say in Mexico, and you sold it, you have to buy foreign real estate, foreign for foreign, domestic for domestic. But otherwise, you have all the options available to you, and that of course means you can go from one state to another, no problem. You'll see the word like kind, and that confuses people because they think it means you sold a shopping center, you have to buy a shopping center. It doesn't. It simply means held for investment or business purposes, not your home, not your second home. Zoning laws, I assume you're asking that question because you're thinking of building something. That becomes a little more complicated. Without going on to a whole other seminar, basically you're buying an improved existing property. You're not building a property when you do your 1031. That's the only reason zoning laws would come into effect, other than you don't want to exchange into something that's not compliant with zoning for all the usual reasons, because you could have a problem later. Hope that answers your question, Wanda. All
right, we have Abel Duck. They say they have several DSTs. How can I combine them into a single DST so I can do a 1031 into a large property? And we'll start with just that question.
There's two different questions. Thank you. So, Abel, one of the disadvantages of diversity, I talked about how it's great that you can mix up your single investment and put it into multiple different properties. That gives you diversity. But I also caution people when we have that conversation that, these 2 or 3 different properties, they're not all going to magically sell at the same time. So once you separate and diversify your equity, it's pretty much going to stay that way. The only exception would be if those 2 or 3 properties all sold around the exact same time, and then you could buy a single asset and put that equity back together. But there really generally is not going to happen in your DSTs. I don't know who you are or what you own, but while DSTs do sell maybe in the same year, depending on the market, it's not likely that they're all going to satisfy the 45-day nomination period and the 180-day close requirement. So once you're diversified, you're pretty much diversified, which also means your buying power is reduced later when those individual properties sell. Obviously, if you split it up 3 ways, now you'll have a third of the equity plus whatever profit each one made. So that is an issue. And then there's a second question.
Yeah, and what is the commission on DSTs, and is that commission negotiable?
So it's a good question. It's one of my favorites. I do talk about that with my clients, and it's a complicated one, and I don't mean to be evasive. But let me put it this way. If you were buying a real estate asset, let's just deal with what we all know, buying an apartment building or a home, there's probably a 5 or 6% commission that's going to the brokers, and there's probably another point or even 2 going into the title, the escrow, repairs, concessions, prorations, transfer tax. So the cost when you buy a piece of real estate, at worst, could be as much as 8%. More realistically, it's closer to 6%. But somewhere in that 6 to 8% is the cost of buying the property and the commission paid to the brokers. And that's just the way business is. That's the way it's done. That's always the way it's been. And I don't see it ever changing, because if those things aren't covered, the transaction doesn't happen. So we now have established reality, 6, 8%, to give a straight answer. Not the commission, but the total load or cost. In a DST, the load is going to be more like 8 to 11%. So it is 2 or 3 points higher in total. Why is that? Because there's a layer of the broker dealers that are involved in the transaction who don't exist in a real estate transaction, and they have to get paid. The individual agents and the commission they get, that's negotiated with their broker dealer. It ends up being, for me personally, about the same as what a real estate agent would get, 2.5, 3.5 points on the purchase price of what you're buying. Negotiate if it's someone who is managing your money. Most of what they call wirehouses, Schwab, Morgan Stanley, Fidelity, most of these big companies actually don't want to trade in DSTs, and they're usually the folks that are managing your money. But of course, not always. We do it at H&S, a lot of smaller firms do. Often those types of advisors are charging a flat rate that's based on your total portfolio value, in which case they may even eliminate the commission or potentially reduce it down. So it really just depends. But that's the way the costs check up. And again, they're a little higher than a traditional real estate asset. But of course, keep in mind, you're not able generally, most of you probably, to buy a $100 million property. Certainly, there's a huge advantage in buying a property that's had tremendous due diligence and review done before you've even looked at it. That's where some of that extra 2 or 3 points goes. And they're going to be coordinating, doing the accounting, giving you your tax report at the end of the year, sending you your monthly distributions, negotiating lease terms, hopefully increasing revenue on the property. All that hard work is done by the sponsor, so I think that there's real value there. But there's no doubt that compared to a traditional real estate investment, it's a couple, 3 percentage points higher, more expensive to the end investor.
All right, Tam, what tips do you have for someone who may be doing their first 1031 exchange in 2026, and that would be out of California? And can you talk about the idea of accredited investor status and what that means in regards to DST investors?
Yeah. Great questions, Tam. Thank you. First tips. What I recommend, whether it's a DST investment that you're doing or just your own property that you're doing, it sounds like you're looking at something out of state, which is fine. Have an idea, a very firm idea of what you're going to acquire, what you're going to buy before you sell your existing property. We call that the down leg property, or what will be the relinquished property. In other words, once you've listed a property, and nowadays properties aren't staying on the market, it's getting a little bit longer than it has been in recent months, but you know that it's going to be about 60 days, 30 to 60 days probably before you're under contract and closing escrow ultimately on your property. By then, you should already know what you're planning on buying. And I say that because the IRS only gives you 45 days from the close of your escrow, the property you're selling, to identify what you're going to purchase, and 180 days from the close of your escrow to actually purchase it. If you get your ducks in a row in advance, you line up your purchase, you can time it so that the exchange happens within a week. of your sale. I know on a DST we can do that very easily because these DSTs are already closed properties, right? They're just selling off equity in an existing operating asset. But even if it's your own property, you can be under contract on your purchase. You're probably going to build into your sales contract that you're doing a 1031 exchange, so you need the capital from the sale of your existing property. But my advice would be to figure out what you're buying right at the same time you're figuring out that you want to sell, because you want that to happen quickly. You don't need to wait 45 days. That's the limit. In fact, you can even acquire the new property prior to the 45 days and be done with your exchange. You won't even need to nominate. That's what we often do for DST folks. An accredited investor is defined by the federal government, the SEC, Securities and Exchange Commission, and it means someone who has $1 million net worth or $200,000 income in the last 2 of 5 years, or $300,000 for a married couple. What the government's trying to establish is that you're a more sophisticated investor, that you can afford the risk of any investment, other than real estate, by the way, because there's no prohibition on real estate. It's kind of a silly number in a way, because frankly anybody who owns a home in California probably is an accredited investor. What used to mean millionaires has a different meaning these days. But that's what they're looking for. If you're close to that number, if that's a challenge to establish that you're accredited, DST might not be for you, simply because too much of your total portfolio, your wealth, might be tied up in a single real estate asset. The government wants to discourage that. Most of my clients, it's really a non-issue that you would count the property you're selling in the exchange towards your net worth. The only thing that they excluded under Dodd-Frank back after the recession, they changed the definition, was they don't let you count your home equity anymore. But that's what an accredited investor is, and that's just for any private placement investment, which is what a DST is considered under securities laws, often called a Reg D offering. It's meant to be not published, not promoted or advertised like I talked about before, and only for high net worth individuals, which they define as $1 million or greater, or 200 or 300 in income the last 2 years.
Awesome. Thank you, Adam, so much. You see his phone number there. You can give him a call directly if you have a question. And we do have a brokerage department here at AOA, so you can give us a call and we can answer some questions or give you a free property valuation if you'd like. And really looking forward to seeing you at the show on August 20th. And until then, maybe we'll see you back here when we talk about ADUs a little bit later today, or we'll continue to try to keep you in the know, provide the content that you need to make the best decisions and operate your property, stay compliant, and maximize your return for that investment that you made. Thanks again. Take care, everybody.
Thanks.